we did present some figures, but actually this is how I came into contact with the Solutions for Business program. Is just before we closed the round, we needed to actually one of the caveats of the term sheet, you could say, was that we prepared our financial projections and model, and I had 2 weeks to do this in, and I've never done that before. So the program, I got 18 hours of help with that, which was very significant. But it's still iterative. We're always changing our model. The most important thing is to say, right, we can make this company survive for 18 months with a really low burn rate. We've got traction, and we have demand, and we know we can make sales.
Just to add to that, if I may, I think the other thing with business planning is that it's always useful to have a base case and a high case as well, with different assumptions underlying both, because that gives you the opportunity then to say, well, if this happens, this will actually occur. And it also gives you the chance to play the business plan according to the type of investor. So you may be looking for sort of 500k from an angel group, you may be $1 million from VCs, but with different assumptions underlying the revenue for both.
I think you'll find that in any term sheet, the requirement for a business plan prepared to the satisfaction of the investor is a standard term. Similarly, they'll insist on things like you producing probably monthly management accounts in a format to their satisfaction, so you can keep the flow of information to them. But as John Moulton, I think, said to us when we started eSynergy, no plan survives contact with reality. And it's absolutely true. Even for our own company, it's not developed the way we thought it would when we started out. Events, dear boy, sort of come along and change your course.
Okay, does that answer the question? Yeah, almost.
There's never any right or wrong answer, unfortunately.
Yeah, one thing I would say though, sorry, last question. What I'm trying to understand is that the model that people invest in, so the actual general belief they have that this is how we're going to invest, no longer, so this is their opinion, I don't know how to deal with it, no longer is relevant to this new Web 2.0. It doesn't exist simply, but maybe for e-commerce sites, but certainly for sites with social aspects, you can't value them because, you can value them like you make up a number, but that's the reality of what people do. So where the honesty and the reality is lost, maybe that's the game you have to play, but it doesn't make any sense.
And I think, is it fair to say that individual angels who are investing their own money and have a great degree of flexibility, they've only got themselves to blame if it all goes wrong, can take a longer view, a more flexible view on what you're doing, and particularly if they're adding something to the business, may be prepared to accept a higher level of risk. Funds who are investing other people's money have to be far more careful in what they're doing, and if they don't get the return on their fund or look like they're not getting a return on their fund, then they have their investors who've put money into their fund on their back saying, how did this go wrong, why aren't you doing better, etc., etc. So I think the sort of cultural approach of individual high net worths to this kind of proposition you're talking about is a better match maybe than some funds which are going to be rather more constrained in the flexibility they can bring to the party.
I think funds have to run a process. So I used to work at 3i. We had a very, very fixed process that we went through. One of those was getting a business plan with a 5-year financial forecast in it that I had to present to my people at my committee. So that was just the process we went through. But as Richard says, now we have a lot more flexibility in terms of the types of investors you go to. And if you are at the early stage, you've got to convince an investor that this is a really exciting opportunity. And we don't really know how it's going to play out, but we're all going to make loads of money. Because that's ultimately what we want to hear, and which is why Facebook is getting the valuations, and Twitter indeed are getting the valuations, because somewhere along the line they still believe that there is a load of money to be made.
But so, if they share the belief with you, they share your belief, then that belief that there is a lot of money to be made will carry them and you through a lot of difficulties and turbulence and changes in direction.
And I'd love to have seen the investment paper that I think it's Kleiner Perkins put together to justify the Facebook valuation they've just done, but they will have put a paper together and it will have been supported by a financial forecast, even if it's made up in terms of, because you don't know how it's going to play out.
And at the other extreme, you may find investors who are basically financial engineering experts, who actually have got a very close time horizon, and what they want to do is to get you listed. So they're interested in maybe 18-month play. They'll do the financial engineering, get you listed, they make their return, and actually they're not that interested in anything other than getting you listed. And of course they can become very irritable if it looks like that listing isn't going to happen, because all of their key performance indicators for their investors are predicated on how quickly they get you listed. It can be a very short-term play, but it's a transition for your company, and it's a financial deal for them as investors. So I think you need to know what type of investor you're getting into bed with.
Thank you.
I have one more. Are you a founder? Is it your idea, or you?
No, it's not. I mean, the particular thing I'm working on there, it's not my idea, but it's I've been working with it. It's pretty good.
Okay. Because that ultimately, the investors are investing in you as a founder, which I think is even more important than the business model, is your ability to execute the business and survive anything. And if they believe you can do that, and you can be agile enough to not see it as anything is fixed, but respond to situations well, that's their ultimate investment is you. Mm-hmm.
Okay. More questions? Any more? Yes, gentleman there.
Justin, was your VC not worried about you not having a precise plan? Was it that particular person? And also, when you're doing homework into an investor, how do you find out what kind of business plan they're interested in? Detail.
The second question is really interesting. I don't think I did any homework on what they were interested in. I think I did the homework that I did was on them as individuals, and what investments they've made before, what they'd done previous to becoming an investor, were they an entrepreneur, have they exited, where have they worked, is the chemistry right between us, could it be right, what expertise do I want to take out of them, and the first part of the question, sorry.
It was...
Didn't they expect it?
Specifically, so you were saying that, also on the panel, that a VC is more likely to want a detailed plan that has a particular exit, a known business model, a known revenue model. Whereas an angel is maybe more likely to take a punt on something where we don't know the exact revenue model yet. But in your round, you had a VC, whereas you didn't have a known revenue model.
I think we were quite a unique. Our situation was unique. So we launched. So we had this, as I talked about in the presentation, we had this very early TechCrunch article that showed tremendous demand and interest in what we were doing. From that article, I got 16,000 emails in my inbox. It was just crazy, and I had had Nina Bianchini from Ning contact me to partner. I had the head of BT Tradespace looking to partner. I had maybe 300 what I called strategic startup gateway keepers looking to partner with Builderbrand because no one else was doing instant branding and fulfillment. And they saw us as a natural fit in their sign-up process or part of their proposition. So I actually came to the VCs with all this traction, and also it's Builderbrand is an invention, and the two things that we own is visualization, and we deal with assets as pure mathematics. So we're not scripting to Adobe Photoshop or Illustrator. And the other thing we have is our algorithm, which is what we call emotionally intelligent search, which we believe is a product in its own right as well. And on top of that, we've built everything on top of an API, so any part of our process can plug into other partners. So we're quite scalable. I think it wasn't right to bring all this traction and all this technology and say, right, we see this as a fixed, we see our business plan as this, but to say, right, this is what we've got, we know we can do something great, and they could see it in that, and then we worked with them on this kind of matchmaking process until we put it into a state that they were interested in investing in.
But I think in relation to the role the business plan plays, with a high net worth, you're dealing directly with the guy who's making a decision on the money. Venture capitalist, whoever you're talking to, may well have to take the proposition off to an investment committee. You won't be there necessarily. You probably won't be there. He therefore has to act as your advocate, and he will need ammunition and means of convincing other people about this proposition. Now, since your advocate isn't you, your qualities as a manager and your enthusiasm won't necessarily come through, so you need the document to convey all the things that you would wish to convey to an investor if you're not going to be present. And that's really why you need a business plan in a readily digestible form that other people can pick through. So it's a very different process from dealing face to face with a high net worth who could put $500,000 in. And he won't need as much documentation.